No influencer can just give a buy or a sell on a stock, give a target unless and until they are registered.
One is that they don't even have the experience. They have themselves not created wealth through stocks and securities or mutual fund, and here they are advising, and they're absolutely misleading.
For me, the first-time investors or the elder class, my simple advice would be to invest in equity SIPs.
I remember my father's advice always to me that if you really want to play this game, you'll have to learn to lose money.
As the old saying goes, there's nothing like a free lunch.
Patience is the greatest virtue when you want to be a stock market player.
Absolutely.
India's stock market has a rich and dynamic history, evolving from informal trading in the 18th century to the establishment of the Bombay Stock Exchange in 1875, one of Asia's oldest stock exchanges. Over the decades, we have witnessed landmark changes that have shaped how we invest today. Fast forward to today, and we are in the era of fintech-driven investing, where technology has made trading seamless, even for the first-time investors. But this evolution hasn't just been about technology. It's also been shaped by major market reforms, policy shifts, and consumer behavior changes. To unpack this journey and understand how these pivotal moments have shaped today's market, we have with us Tushar Shah, CEO, Infrastructure Finance and Director of Aditya Birla Money Limited and Asset Reconstruction Company Limited with us. He is a leader with deep expertise in corporate banking, investment banking, and financial markets. Tushar Shah has played a pivotal role in shaping businesses with a strong background in stockbroking, structured finance, and market strategy. He brings valuable insights to the table. Tushar, welcome to In the Spotlight. Really glad to have you here. This is one topic which is really interesting, is about the stock markets or the bazaars, or many things that people call. And this has been the conversation today, lately, in all the dining tables in the family's household in India. And if you ask me, I feel this is what, in fact, makes the government or breaks the government. It's been from pre-independence to now. So there is a whole journey that the Indian stock market has seen, from really a physical training, paper and ringing the bell, to all the way now with fintech and on your fingers. So I am very keen to know and understand your journey, Tushar, because you've been a corporate banker, you've been an investment banker, and you came to Aditya Birla Capital, did the entire turnaround of this our ABML business. So what has been your journey all these years?
So first of all, thanks Darshana for having me on this episode of Spotlight. My journey, it's been a very incredible journey. I joined in November 2011 the Aditya Birla Finance Limited. I have always been a corporate banker, a corporate lending and investment banking in my earlier organization. So I was asked to set up the wholesale lending platform in Aditya Birla Finance. Thereon, then this opportunity came up in 2016-17 for Aditya Birla Money, which is the stockbroking business. And then in 2018-19. I had the opportunity for starting the asset reconstruction platform. So that's my journey, been in the Aditya Birla Capital Group since 2011 till date.
How have you seen this landscape changing of the entire Indian stock market over your years?
I started my career in the 1990s. The entire landscape of stockbroking has changed significantly. But if I were to just go back prior to my, starting my career, this stock markets were set up, Bombay Stock Exchange was set up pre-independence. But that point in time, the trading was more in, cotton stocks and all. Then the government post-independence set up the Securities and Contracts Regulation Act in 1956. Then UTI set up the first mutual fund roughly in the 1960s. The cult of equity started with the listing of Reliance Industries in around 1977. And then the actual cult where people picked up what is stock market happened during the time of Arshad
Arshad
Mehta.
Mehta,
Now we remember him for the scam, but if I were to give credit for the cult of equity investing, it is at that point in time it really got over. Prior to that, it was more of a close club of operators which used to drive stock investing. And then we had various, the National Stock Exchange was set up in roughly, I think, in the 90s. And that actually overtook the Bombay Stock Exchange in terms of stock market. Today, the volumes of National Stock Exchange are 3 to 4 times of the Bombay Stock Exchange. And coming to my, if you were to say from the 1990s till date, I think we have had lots of ups and downs. Lots of events have happened. We had that Harsha Mehta scam. Then we had that liberalization in 1991 during the time of Narasimha Rao.
Yes.
Then we have had a lot of adverse impact. We had the dot-com bubble in the 2000s.
Yes.
Then we had the 2008 global financial crisis. Then we had demon in 2016 and the COVID. So these are the bearish cycles which have happened in between. But the last 4 years or post-COVID, I have never seen the frenzy, meaning the stock markets having such a bull run.
Absolutely.
The way it has been in the last 4 years. People have minted money in the stock markets.
And it's also spoilt and made everybody feel, the younger ones who are coming in, you can just make money.
That's true.
Like this.
I think that's true. As of today, a lot of people feel, because if you have the chai wala and the kirana store and everyone starting investing, it's a good thing, but they don't realize that there is no free money to be made. Like for example, if you look at the markets going forward, I don't see the same bull run which was there in the last 4 years. And now what has happened, we have become globally insulated. We are not independent of the global factors.
Correct.
So even if our economy is going to do well, it doesn't mean that the markets are completely insulated of global factors. They are very well insulated, because today around 18% or 20% of our market cap is held by the FIs and the FPIs.
Correct.
So, that's how our markets work, and I've moved over the years. In fact, today our Nifty is around 24,000. It used to be, I think, 4,000 or 5,000 in the late 2000s. So it's been a massive run. The Sensex has crossed 75,000. It used to be some 8,000 in the 2000s.
So we've seen almost 8x jump, in
absolutely.
the way the whole journey has been.
In fact, even from COVID also, it has more than doubled. Much more. In fact, it has tripled.
Yes. So in fact, that's interesting but I feel the one of the, industry or the players, the fintech players, has a lot to add to, really opening up the whole stock markets. I remember, Tushar, when, I started my early career in 1995, and that's when, the ESOPs and IPOs, and I had a account, ICICI direct account, but it was managed by my dad. I still didn't know how to, and he was a traditional player. He would call his broker, and he would still do, whilst there is an online account, he would still talk to his broker, and that's how it was getting dealt. To today, where everything is on the fingertip. So there is a whole generation change. And I see in the houses where there are still the experienced or the older parents or the senior citizens are still, they want that trader. They want to talk to someone. They still want that connect, whilst the younger ones are on the, on the app. So how do you see this trend moving?
So you're absolutely correct, Darshana. There has been a generational shift in how, people are investing in the stock markets. You're absolutely correct. In fact, even as of date, the older generation prefers to deal through the dealers. They seek their advice and then they place their orders. It is the new generation which are tech savvy and who prefer to do investing either through the web or through the mobile trading. So it is this new generation who do self-trading, who come, their apps are very user-friendly. They come, they trade, and they prefer to do that. So that's how also the volumes have increased, because of the new generation, the new retail class which has come into the play. The older generation and the FIs and all still deal through the broking
Brokers.
houses.
The
They don't,
brokers.
obviously, they don't do self trading. So, just to explain Aditya Birla Money, we are a hybrid broker. So,
Okay.
we have branches also and we have online also. So, we offer both the choices. We have traditionally believed that this would be the right model, because if we were to switch completely to the discounting model, there's a lot of cash burn because there is hardly any brokerage to be earned. And if we were to completely switch to online, it would cannibalize the brokerage which income which we are earning. So that's a conscious decision which we have made, and there are many large brokers today also who are having a hybrid model which offer both.
And I would assume that when with the broking houses and the branches or the brokers, people will be investing more serious, more large ticket sizes. And on the app and all, it's a younger, the retail audience who's sort of flirting, trying, testing.
Partly correct. So again, explaining on the Aditya Birla Money, we have actually trader clients and we have HNI clients.
Okay.
We give them the benefit of trading through dealers because the cost of a dealer is high. The branch, maintaining a branch and all is also high. So the traders and the HNI clients of ours, which are there, they do through the branches and the dealers. Whereas the younger generation and the smaller ones, like you mentioned, they come through the self trading. And you're right, but the volumes are so large
Okay.
of these, the younger players,
The retail.
the retail
Place.
class, that
It
that makes
balances.
up for the volumes and the this thing. In fact, if I were to just say in the last 3 years, last maybe 2 years, there's been huge amount of FI selling which has happened. It has only been insulated by the domestic mutual fund and the retail class. Meaning it has been an amazing turnaround which I have seen, because at that point in time, the earlier times, prior to this 2 years, whenever an FI used to sneeze also, they used to start selling, the markets used to tumble and crash. But the domestic mutual funds and the amount of money flow which is coming into the mutual funds and the retail and the individuals which are trading have helped the
There.
stock markets.
Oh, interesting. So you're saying this whole volume of the new retail investors and the whole mutual fund people coming in. So that's really interesting. I think that's a interesting insight. But tell me truly, this whole democratization of what the fintechs have done, and given accessibility and power in the hand of the consumers, that a lot of tips are given, lot of, and like you said, discounting, there is no intermediary, and there are daily tips, there are top stocks to invest in, and a lot of these things are given. But does it necessarily mean that anybody can go and do it, or do you still need to have your conventional understanding of the market?
So just to give you a statistic, SEBI has made it mandatory for every single app, where the opening screen says that for FNO, I'm talking futures and options, that 9 out of 10 investors lose money, and this is historically proven.
Oh.
That 9 out of 10 investors lose money in FNO. This is just to warn the investors who are dealing in FNO that I'm just coming to your point, that without an understanding, just dealing in basis tips, basis rumors, it doesn't work in the long run or the medium run. In the short term, you may get away with it. Coming back to your other point about influencers, we have those so-called
Oh, yes.
influencers giving market knowledge, giving targets. I think SEBI has now imposed a lot of regulations. They need to be registered with SEBI. No influencer can just give a buy or a sell on a stock, give a target unless and until they are registered. And there are lots of do's and don'ts for these influencers, because they were having a free run and people were blindly following those influencers, and
No,
they were.
absolutely, absolutely. And I echo your sentiment, Tushar, because this whole, and it's great that the regulator has intervened, because I, as a marketer, would always question that how can I this finance with someone and get rich in, 3 months, masterclass in stocks and securities. I mean, the kind of things they use. I mean, the one is that they don't even have the experience. They have themselves not created wealth through stocks and securities or mutual fund, and here they are advising, and they're absolutely misleading. So that even I echo your sentiment, and I'm glad that SEBI has intervened. But I still see a lot of these influencers really coming and they actually, take away people's money. So what would you advise to our listeners?
So, see, first-time investors, for me, the first-time investors or the elder class, my simple advice would be to invest in equity SIPs. And equity SIPs also, what typically happens, Darshana, where people come in a bull run. So when the
Yes,
markets are moving, they come. The
correct.
moment the markets start falling, they tend to withdraw their money.
They panic.
So they panic. My simple advice to everyone is, see, it's not a small term game, because even in an equity SIP, just to give you a small example, I enter, say, 1 year before. You have entered, say, 2 years before. The returns and the same fund, the returns and the stocks also may be the same. The returns which you would have got when your entry timing was better, let's assume you came in at the bottom, may be far different than what I have earned. I may have earned a loss and you may be earning returns. So you have to have a time frame of around 5 years to 8 years for any equity SIP scheme to really give you the returns.
That's a whole compounding
It's a whole compounding,
interest.
because today I buy Maruti at 8,000 and I buy a Maruti at 12,000. There's a whale of a difference. The stock is fundamentally sound. But the timing, when I enter at 8,000, will give you far more return than a timing of entering into Maruti at 12,000. So a simple advice to first-time investors who are not used to algo trading or who don't go by fundamental analysis would be to invest in equity SIPs or mutual fund. Leave it to the specialist to earn returns. Yes, I agree the returns may not be something great, but traditionally 15 to 18% returns is one can easily get if you invest in equity SIPs over a period of time.
Then what would be, according to you, the right time for somebody to then enter into actually the stock market? Because today a lot of youngsters, and that's where, I remember my father's advice always to me that if you really want to play this game, you'll have to learn to lose money. Because I would say, no, I don't want to. It's my hard-earned money, but you will lose money to learn how the stock markets work. And I don't know if it is fundamentally true today also. And a lot of these young ones who are coming in and wanting to make quick buck. And, and I would see my team members saying that, oh, today this is the tip of the day. We want to make it. And it's that whole instant gratification world that we are living in. We want mobile phone in 10 minutes to making money in one day. So what is then the right time?
As the old saying goes, there's nothing like a free lunch.
Yes.
And there's nothing like you make money the short term. You may make money the short term, but typically what happens, that person again puts the money back into the stock markets. And then obviously over the long term, if you were to average out, you lose money. So there is nothing like instant gratification. The timing is very difficult, Darshana, for one to sit on money. See, that's a typical problem all of us have, including the mutual funds have. Even in a bull run, more and more people keep on putting in money. Now, they don't have an option. Very few have the heart to say, I will not take more money, because the markets are already overheated, overvalued. They will keep on investing that money into that overheated stocks. When the markets go down, the returns for that class of investors will come down. So there's nothing like a right timing, but like I said, the time frame or the horizon which one needs to look at has to be larger. The best timing, if one can say, and one is able to sit on money, idle money in a bank and wait, is obviously in a falling market. But then the stocks can keep on falling. You have to bite that timing out. But that's the best time, because the Indian stock markets have been delivering returns over a long period of time. There's no question about not getting good returns in the stock market.
So it is cyclical.
It is cyclical, and you have to be a patient.
You have to have patience. And this is very important for all our listeners, that patience is the greatest virtue when you want to be a stock market player, because you really have to. And then according to your advice, today we are in a bear market, a bearish market. This may be the time to actually invest more and not really, remove your money.
So let me correct that, Darshana. I would not say this is a bear market, but the returns one has seen in the last 3 years, I don't expect the same set of returns in the next 1 year. Indian economy may grow, but the markets are already overrated. Just to give you some statistics, we are a $5 trillion, slightly 10% here or there, $5 trillion market cap. Of the market cap of all the stocks listed on the stock exchange. Our GDP, the gross domestic product, is roughly around $4 trillion. So we are around 125% market cap to GDP ratio. Anything over 100 means that the markets are overheated or
So
overvalued.
it has to correct.
It has to. But now let me give you example of other countries globally. For example, the US. US has historically been over 150%
Wow.
of the GDP. So today they are at around 190, 200% of their GDP. Their GDP roughly $28 trillion. Their market cap of all the stocks is roughly $65 trillion. Japan is the next, which is around 150% of, they have also historically been high. China is 65%, which means it is undervalued. But that doesn't mean that people will put in money in China for different reasons. But yes, the thumb rule says that over 100% of market cap to GDP ratio, the markets are overheated. Below 100%, it is slightly on the undervalued, depending on how low the percentage goes.
But if I have to compare with Japan and US, we still have a run if we really have to.
That's true,
make our-
but US is a very different story. Very different story. They can live with the sort of deficit which they are running, and the dollar is the world, meaning it's a global currency for people to hold. No other security or currency comes near. So you can't compare US to the India stock market.
Story. Awesome, Tushar. Now coming back closer home to Aditya Birla Money Limited, and yes, like we know that you being a corporate banker, an investor, had come here to start, the wholesale lending business, and then you turned around ABML. Now you made it profitable at Aditya Birla Money Limited. So tell me, how has your journey been, and how are we different in the market, because there's so many players. So how are we differentiated?
So, Darshana, Aditya Birla Money in 2016-17 was a very different story. We were expanding our branches, we were increasing. Our employee base was around 1,000. Our branches were around 70, 75. Most of our branches were bleeding red ink. And the markets were also, because stock markets, the brokerages were already coming down. The brokerages have consistently kept on coming down with the fintech players which were there.
Yes.
So that situation was very delicate, but yes, one by one we took remedial steps, and we have successfully managed to turn around ABML. Today ABML is in a very, very different shape from what it was in 2017. So it's been a great journey. We have added 2 new lines of businesses. Apart from stockbroking, which was the only business, we have added the wholesale debt market segment. So we are, I would say, the only stockbroker who offers this debt trading platform. We do volumes of around 30,000 crores per year, which is the highest in terms of the broking. So that's a good profitable business which has helped insulate the stockbroking business. And the last one which we have added is the distribution business of financial products. It's on an open architecture basis. We are not only offering Aditya Birla Capital products like life insurance, health insurance, and that's the third business which we have started a year back. So along these 3 businesses will help insulate in the vagaries of the stock market. So with that intention, we have started this, meaning these last 2 businesses which are there. Coming back to how have we differentiated. So today, like I have already explained, we have grown into a different, we are still small. And we have a long way to catch up with the other brokers. The other brokers which I was referring to some time back, the new fintech players, there are a lot of cash to burn. They are all private equity funded. We have not had the cushion or the liberty to do that cash burn, and neither are we in that position to do a cash burn for acquiring customers. So we are offering, we have just launched a new app, the Elevate app, which is, I would say, and basis the feedback which we have had from the internal our customers and all, is it's a very seamless, very user-friendly app. One of the best trading app, competes with the Zerodha and the Grow app.
Oh, very nice.
It has a very smart watch list. It offers first of its kind features. And I hope that app itself is good enough to entice the new generation of customers and the first time millennials and the zillennials, as we call it, into this app, because it's a very seamless app and one can invest in IPOs, one can invest in the stock market. The KYC is very easy. So I think that's one way we are differentiating. Otherwise, I think everything is broadly the same. We have a discount model, also discount brokerage model for self-trading, and we have the normal brokerage model for people who prefer to deal with the branches or the dealers, because the cost of having a branch and the cost of having a dealer is very different. So we are offering both sort of models for the class of investors, and we hope that in the next 3 to 4 years we will also be one of the stockbroking companies to reckon with.
Of course, we will. And I would urge all our listeners to definitely download Elevate app. It will be available on Google and Apple stores, because the kind of experience and expertise that a brand like Aditya Birla Capital will carry, and so with that the kind of knowledge and the information or the advisory that you will get will be far more far more experienced, far more insightful, and it will definitely help you get into the journey faster. So I would definitely urge everybody to download Elevate, Tushar. Tushar, as you know, that we also take a lot of audience questions. We go on our social, because in the spotlight has been now here for a year, so we have viewers asking us. So I'm going to pick up some of the audience questions now. We're going to shift the gear.
Sure.
And so there is a question from a 35-year-old independent working woman, and she has been investing in mutual fund for the last 5 years. And like you said, it's good to start with mutual fund and SIPs. But now she wants to explore in the stock market and become an active investor. So where should she start, and how can she balance her portfolio?
So my suggestion or recommendation to the investor would be basically to invest in equity SIPs, because you typically tend to average out the returns. She will not have the time, working woman not have the time to analyze and understand the stocks and also daily look at the stock, because typically the habit of an individual investor, if they invest, is to they look at the daily price charts.
Yes, yes.
And then they either panic or they feel exuberant. So there's no point in looking at a stock daily. So my sincere meaning advice to this woman would be to invest in equity SIPs with a 5-year horizon. Depending on how much of free cash flows she has per month, and she can invest in 2-3 schemes. There are enough wealth managers who are there. Aditya Birla Money is there to guide her as to which are the schemes one can invest in. But that would be my suggestion to
Because
her
you
to
don't
invest.
have daily time to keep looking at the market.
Absolutely, and it's a wrong thing. In fact, that daily
panic.
looking at the stock prices, which most of the people do, investors do, it's not the right way of looking at it,
So
because
that's a very important point, and I would like you to elaborate on that. That why is it? Because this is what people have the habit from 9 o'clock. They're glued. They're looking at their phone. And why would you say it's not wrong? Because this is really how people are.
So I mean, the trader clients, yes, it's their business.
Correct,
It's
it's
their
their
daily
business.
roji roti with they earn, and that's their business. They have been doing it. But for an investor, like the
Retail investor.
example which you gave me,
Yeah.
who is already working, who doesn't have the time, for her or for him to daily look at stocks and leave aside that doesn't make any sense, because stocks do not give you the returns immediately.
So quickly.
So quickly. At least one should not expect, if they give, nothing like it.
Yes.
So that is why the advice that invest gradually, invest in 3-4 schemes, don't invest only in one particular, because the performance may be different across schemes, and with a longer term horizon, and not look at the stock prices or the NAV of that portfolio on a daily basis. That's not the job. You leave it to the professionals to earn you returns.
Awesome, because I'm just giving an analogy. It's like when you are on a weight loss journey. If daily you are standing on the weighing scale, it depresses you. Similarly, if you keep watching the market daily and you are not, you are not a trader, it's
Absolutely.
best to avoid and believe that and
Absolutely.
you've invested in the right
So there's
place.
another portfolio management scheme where I have a minimum ticket size of 50 lakhs.
Correct.
Now I would not suggest a first-time investor to also put in the money in a PMS, because like I was giving you that example, the entry point is very important.
Portfolio Management Services, or PMS, is a financial service where professionals manage investments for clients, typically HNI individuals and ultra HNIs. They create personalized investment strategies using stocks, bonds, and other securities, balancing risk and returns while navigating stock market fluctuations. PMS helps investors grow their wealth with expert research and risk management.
And once you put in a large sum of money, the timing is wrong, then that money where you have already invested a large sum of money may not give you the return. That is why on a monthly basis, if you have an equity SIP, your returns get average out.
Absolutely agree. So Tushar, now we have here another, consumer of ours, Mr. Alok Sharma, and he's asked that with the market constantly going up and down, I often find myself unsure. Should I stay invested or pull out my money to avoid losses? So he wants to know that what is the right decision during volatile times.
So, Darshana, again, I go back to my earlier conversation where I did mention that one has to have a long-term horizon. A 1 year horizon or a 2 year horizon is not the best horizon. You have to have a longer-term horizon of around 5 years for you to ride, and it's best not to keep on looking. Indian economy is going to grow for sure.
For sure.
For sure.
India shining.
India is shining. I think we are best placed globally, one of the best placed countries globally to have. Our government is ensuring that. So I think we are in for good times. We may not see the same returns as what we have seen in the last 3 years, but that doesn't mean that you will not get that 15 to 18% returns going forward. Yes, it become a stock pickers market. You invest in random stocks or small cap stocks, they will not give. So my suggestion to Alok Sharma would be to do, if he is an astute investor, to do good stock picking, good fundamentally sound stocks, not go by the tips and suggestions which the markets are given or his friends are given, or again switching back to the equity SIPs or hedging his bets.
I have learned some new terms, overheated, and it's a stock pickers market, so we have to watch out. But essentially, Tushar, I absolutely appreciate what you're saying that we need to have patience. It is a long term game. Don't go for advices and tips, and that's why I believe in brands like Aditya Birla Money, who has a lot of research, who has a lot of technical tools, algos working, and then we really come from that and tell our people where to invest.
Absolutely.
So interesting. Now, coming to whilst we've spoken about how this entire evolution of stock market has happened, and when you do future gazing, because there's a lot of newer things, the whole crypto, the up and down and the bouncing back of crypto, and we know what Mr. Trump has done, and the entire blockchain. So, where do you see this, entire game and the stock markets moving to in future?
So, Darshana, cryptos I don't understand at all. Meaning, finally, if I were to, as a layman, I'm saying cryptos, there is no collateral. I don't even know whether the processes and the systems are safe. And look at the movements, meaning like that $40,000 Bitcoin can go up to 90,000, 100,000, and within 2 months it can fall down to 50,000. Meaning you have to have a heart of stone to invest and stay invested in these cryptos. Okay. But this large, meaning the likes of BlackRock and all are also selling cryptos. It's not that they are not, and they are encouraging investors to buy. But there's no underlying collateral in these cryptos, and I don't understand
and there's no
that.
regulation also.
Regulation, and there are a lot of investors or a lot of market veterans who also feel the same way. So I would not advise anyone to put monies in crypto. I would not advise anyone to put monies in an asset class where they don't understand.
Correct.
Like for example, if I were just blindly following someone else's advice or tip and investing, doesn't make any sense. Either you leave it to professionals, and if someone is really keen, then invest in a fund or a scheme which invests in cryptos and who has the ability to, who has the technical know-how, who has the algos to buy and sell or trade or churn, rather than trying to invest in directly. because we don't understand, I don't understand this market of cryptos. Coming back to the stock market gazing, very difficult to say, but I've already stuck my neck out to say that I expect the markets to be relatively a stock pickers market. Certain stocks will do well, certain stocks will remain flat, and stocks which performance is not up to the market expectations will fall down. But to expect a market movement or one way up, I don't think will happen going forward in the next 1 year horizon.
So, Tushar, now that we've covered, let's do future gazing and tell me what are the future plans for Aditya Birla Money?
So I've already mentioned to you the three businesses which are in. Obviously, we would like to scale up each of these businesses. The last one which I mentioned was the distribution of financial products, which is on an
Yes.
open architecture. That is a huge scale up opportunity. Meaning we are just at the tip of the iceberg. I think the amount of money which we can make on the distribution is enormous. The wholesale debt market will continue to grow the way it has been growing. Stock market, like I said, our presence in the institutional segment is pretty small
Small.
as of now. It's a large, very large potential. It's a long-term game because empanelment with mutual funds and FIs take time, bases your research, how strong your research is.
Okay.
So I think it's a very very robust, very bright future which Aditya Birla Money has.
So, Tushar, awesome conversation, lot of insights, and a lot of learning for me personally too. But I'm going to now switch the gear and let's have some fun and engagement because
Sure.
this category or stock market has a lot of names and we want to demystify and de-jargonize. So we have a bowl. You think it's your magic bowl? Please pick up the chits and go for it, and please demystify it for the
Sure,
audience.
sure. Let's start. The jargon in the stock markets is pretty simple compared to the other jargon which I come across in the medical field or the financial
Of
services field.
course,
You have so much of jargon.
I absolutely agree.
So I think this is on derivatives. So derivatives is an option to buy or sell stocks. I'm talking from the stock market angle because derivatives can mean anything at a future date, at a future specified date. So FNO would be a complete futures and option would be a complete class of derivatives.
Okay.
So it depending on whether I expect a particular stock or the Nifty to rise or sell, I will accordingly buy or sell a derivative.
So it's a future bet that you are taking.
It's a future
hedge.
bet which I am taking and basis certain view which I have formed.
Let's go for the next one.
This is penny stocks. So penny stocks are typically illiquid stocks, low cap stocks which are more, if I were to say historically, more promoter owned. In fact, promoters may own more than that 75% limit which has been prescribed by SEBI through other of their own fraternity. And penny stocks is typically where you are referring to the tips and all, and they give you the maximum returns, but they are completely operator driven. Now, whether they are independently operator driven or whether they are done at the behest of the promoter, today SEBI has become extremely sharp on penny stock because they have all the technical know-how at their behest. They study the volumes. If they see a penny stock has appreciated significantly and the volumes have exceeded the average volumes, they'll immediately start their surveillance and ask questions and they'll shift. In fact, if a stock has grown up exponentially, they just remove it from the trading platform and they allow a cool off period.
Let's go for the next one.
So this is commodities. So today we also have commodity exchange on the National Stock Exchange and on the MCX exchange.
Yes.
And the commodities trading which are being done as of now, the highest trading is in gold, silver, crude oil and base metals, copper. So you can again do derivatives on commodities or you can buy futures and options on commodities. So if you feel crude oil will go up, you take a bet. If you feel crude oil will come down or if you feel you are able to understand the gold and the silver, but these are very active markets and typically lot of, in fact, even the like Hindalco, they are
Yes.
big in aluminum and big in copper. They can they can hedge their bets on this. stock exchange. So Aditya Birla Money does a lot of trading in commodities for Hindalco.
Hindalco.
So we have Vedanta also who are there active, and also it's a large market. It's globally, it's even a larger market, and much more products are there. In India, gold, silver, base metals, and crude oil are the main commodities which get traded. Day trading. So basically, day trading is, we call it intraday trading. So you buy in the morning or sell in the morning, and you do the reverse. You square off the contract at the end of the day.
Okay.
And for doing intraday trading, you have to keep a margin with your broker, because tomorrow if there is a loss, the pay-in has to happen on the same day, so that margin is adjusted.
Okay. So you have to, the broker
Yeah,
will
so
keep.
unless and until you have a margin, the broker will not give you the limits to do day trading, intraday trading. And that is where the churning happens a maximum. And that is where also Aditya Birla, this trader clients which I was talking about, they maximum what they do is day trading. But their business is only to do day trading.
So it's advisable to do because traders know it well. It's not for retail investors
It's not for
who.
retail investor to do day trading, no. Because either one is taking bets without knowledge, or one is going on technicals and algos. So obviously the technicals and algos earn money. An ordinary investor will lose money if they try intraday trading. A bull market and a bear market. So bull market, as the name suggests, is on an upward trend. If you see a rising trend on the stock markets, it's called a bull market. Teji.
Yes.
So the Hindi acronym is Teji. And the bear market is something on the reverse. So if you see the markets going down, and the Sensex or the Nifty continue, it's called a bear market. So both, it's cyclical. Nothing is permanent in life. The same way nothing is permanent in life for a bull market or a bear market. Everyone was thinking, okay, we are in for a bull run, and for 4 years we saw a one-way street,
one-way
a bull
street.
run. And today now people are saying they are entering, I would not say a bear market or a bearish market, but people are not seeing the return. So I would say it's a neutral market. But things change overnight.
What about IPO? The whole.
So IPO is an initial public offering, and typically an IPO is like the listing. So like I'm a company, I have been in business, I'm having revenues, I'm having profits. Profits may be there or may not be there, because this tech stocks and all which are coming in, or this Swiggy's and all, they don't make profits, but the valuation which is given by the markets is enormous.
Correct.
Much more than the old generation manufacturing.
They've just changed the game.
They've just changed the entire horizon.
Yeah. Let's go for the next one.
So blue chip stocks have basically, having consistently delivered returns over the years. These are sort of very frequently highly traded stocks, very liquid stocks. So more or less all the MNCs, the multinational stock, which have a very high level of corporate governance, who have been consistently performing, are referred to as a blue chip stocks, like an Asian Paints or a Nestle or a Hindustan Lever or a Colgate Palmolive.
Correct.
These are traditionally called blue chip stocks. They give you muted returns. They don't give you spectacular returns, but they are safe stocks to keep. And they have, over a period of time, they have given phenomenal returns to the investor class.
Investors. Interesting. Tushar, wonderful. Thank you so much, and wonderful having you here in the spotlight. A lot of learning, lot of knowledge, and lot of you've also advised how to stay away from not really getting carried away. Patience is important, and do the right learning. Follow Aditya Birla Money is what I would say. But thank you so much, Tushar.
Thanks, Darshana, for having me over, and it's been lovely speaking with you and having this podcast. Thank you.
Thank you. Super, and now that's a wrap. We covered everything from the history of India's stock market to how you can invest smarter today. Huge thanks to Tushar Shah for sharing such valuable insights. If you found this helpful, don't forget to like, share, and subscribe for more conversations like this. See you in the next one.